Welcome to today's Finextra Research webinar, Stablecoin Settlement, Why PSPs Can't Afford to Delay. I'm Scott Hamilton, contributing editor for Finextra, and I'm here to lead a conversation and explore important insights on that topic with our audience. Before we jump in to what should be a very compelling discussion with our experts, two quick notes. You're encouraged to ask questions, and we'll do all we can to answer as many as we can during the session. And you're welcome to download two resources from our sponsor, Fireblocks, you'll see on your console there. Now, payment system providers have lots on their plates right now, along with their customers in the banking world. So many options for jumping on the stablecoin train, if you will, and yet some aren't making the decisions they need to as fast as they might find, ironically, prudent. 86% of firms now report that they're ready to add stablecoins to their listed digital assets, and many of you probably joined today's call to learn about some of the most successful use cases out in the marketplace now, and perhaps to help determine or compare your own rollout strategies. We'll share a few of those for sure, and knowing that some of you are wrestling with all the discussions around stablecoins versus tokenized deposits, which more and more are looking like complementary rather than competing options for financial services transactions of various types. There's another big C word too that we haven't mentioned, and that's compliance. And don't worry, because we'll be talking a lot about that and how regulation and procedures fit in here too. For payment systems providers around the globe, though, there's all these decisions on what to buy or what to build. But the most important decisions or recommendations just may be to first take a very close look at your current and preferred markets, your customers, and what they want and need from a stablecoin platform, then go build it. We've said it before, but even though the rules change frequently around digital assets, it's still true that tokenized money and blockchain innovations haven't just arrived, but they're obviously here to stay. So the questions everyone's asking include, where will all the pieces fit into their overall deposit, investment, payment plans, both now and in the longer term? What choices and decisions must PSPs and merchants make right now or soon to make the most of this opportunity and stay competitive or not? It's not just about lower costs, speed of execution, or other efficiencies, though these factors do loom large around decentralized finance in general. It's not just about USD stablecoin primacy after the Genius Act's arrival, nor even about how earnings or reward options will be, hopefully, clarified with the Clarity Act soon. It's not just about what's going on globally with the EU's MiCA or the markets and crypto assets regulation, with issues arising in various regions all around the globe regarding financial stability, monetary sovereignty, security, and governance of these programs and products. It's also a lot about the rise of all sorts of stablecoin programs and consortiums or consortia being set up to manage them, either in closed clubs of leading financial institutions, maybe some of their customers, or how public or private chains, on-ramps and off-ramps to fiat currencies are all going to really work together, especially if multiple regions or countries start issuing their own stablecoins, for example. And then, yes, there's AI and how it impacts everything right now, including the questions we're tackling today, with an outstanding group of experienced and talented panelists. Neil Chopra, Head of Strategy and Business Development, Americas for our sponsor, Fireblocks. Heinrich Venzke, Director of Product Management, Blockchain Solutions for Nuvei. And Muneeb Shah, Head for Digital Assets Technology Consulting, UKFS for EY. Neil, let's kick off the session with an overview of the present PSP approaches that you've seen in the stablecoin settlement marketplace. And yes, cross-border applications still rule the stablecoin world right now. Any other use cases to help the conversation get started?
Yeah, Neil. Scott, thank you. Thank you very much for having me. Muneeb, Heinrich, great to see you guys. I think the really interesting element that we've seen over the last few years at Fireblocks and just my career in general, I spent 10 years in the corporate treasury space, in the past 9.5 to 10 in enterprise blockchain, is this concept of utility of the technology is now stepping to the forefront, which is very exciting. The first scaling utility use case we're seeing is with stablecoins. And I think there's a lot of reasons for that. We can certainly get into that during this session. But one conversation I had about 1.5 years ago now with the CEO of a very large B2B firm, I think tells the story very well, is payments firms have traditionally been a toll booth on a highway taking a clip of a transaction along the way. Whereas in order to stay competitive, you really need to look at the underlying or fundamental business model that you're looking to deliver to market. And I think what we're now seeing with what Western Union announced about a month and a half or 2 months ago, the MoneyGram announcement earlier today of issuing their own stablecoin is how can you leverage this technology to actually keep funds on platform and deliver novel products and services to your users. And I think this all ties into embedded finance, AI and agentic, whether it's payments or portfolio management. And I do think that that's a big consideration for a lot of firms right now to say, what is the long-term vision of what our company looks like? How can we leverage this technology today to drive efficiencies around cross-border payments? And the two largest traditional PSPs and remittance platforms out there are going all in on this technology because they see the pain that we saw, that I saw for 10 years in the corporate treasury space, which is prefunding of nostro accounts, trapped capital and liquidity globally. And now if you can leverage a stable coin to actually move value in real time, you can unlock capital and now put that to use. If you can now also issue your own stable coin, hold the reserves that back that stable coin, take all the yield, then it's a question of how does clarity actually allow you to enable and broaden financial services that you can provide to your client. This is really coming to a head, I think, over the next couple of months and quarters. But at the end of the day, what we're seeing now are large payments companies, whether it's P2P or B2B, they all have the same issue, which is correspondent banking, prefunding, nostro-vostro relationships. And what this unlocks is the ability now to get direct to users by offering them wallet technology, the ability to hold stable coins and other assets of value within the platform. And again, look to broaden out those financial services that you can provide. But again, looking at it more tactically in the short term, it's really an evaluation. And Scott, you hit the nail on the head of risk, compliance, technology, and all the other pieces that come together to actually enable this, and not necessarily saying we're going to disrupt our existing business by launching something brand new. Is how can we insert this technology into what we do today, prove the efficiencies to have that foundational technology layer that has the compliance, risk, KYC elements embedded within it to then be able to grow and scale.
Excellent overview. And there are a lot of questions that every provider is facing. And it's really going to be about what works best for them and their customers. Heinrich, you've done lots of research and outreach to merchants. We talked about it before the session. Any thoughts you might add to Neil's comments? And then specifically for cross-border users, what use cases are you seeing stand out and where are they standing out? And any surprises in what you've heard in the recent rollouts from PSPs about stablecoins?
Thank you, Scott. So we've spent a bit of time at Nuvei doing a lot of canvassing from our existing merchant base, and there's been a very interesting shift over the last 2 or 3 years when it comes to digital assets in general. So maybe 3 years ago, the conversations you would have had with merchants and decision makers on that side, there was a real reluctance around crypto and stablecoin in general. It was seen as a big risk. The value propositions weren't very clear or obvious. And, it was seen as a place where, people do gambling on crypto, basically. So that's really shifted quite dramatically over the last few years. So we now have merchants that are coming to us asking for solutions around digital assets and stablecoins. The value proposition is becoming increasingly clear. So the market itself is getting much more educated in terms of what it is, how it works, what the benefits are. So it's been a very interesting shift, and increasingly now we are seeing demand from merchants that are what we would call traditional merchants that traditionally had nothing to do with digital assets, right? So 2 or 3 years ago, our merchant base with regards to digital assets would have been players that are already operating in the digital asset space in some capacity. Now we're seeing demand from merchants for various products that don't really have anything to do with crypto or stablecoins. They see it as a solution that meets a need. And so they don't really care about I mean, when I say I don't care, they're not so much concerned by the fact that it's stablecoins or blockchains. They care about the solution that it brings. And to me, that's a very exciting space for us to be in, because after all, blockchain and stablecoins and digital assets should just be behind the scenes infrastructure that makes our financial and payments world more efficient and more effective, and we can do some new things. And the complexity of the blockchain itself and how digital assets works should be abstracted behind the scenes. That's now starting to happen in the last few years. So in terms of some of the merchant demand cases we're seeing an increasing amount of merchants that are coming to us and saying, hey, we've got, in terms of payments acceptance, we've got a segment of our customers that are demanding to pay with crypto and stablecoins, as opposed to using their credit cards or whatever other APMs they may be. So we're definitely seeing growth in that space. We're also seeing a significant demand, particularly in some geographic regions, for settlements in stablecoins. So settlements from the payments acquiring that we do. This is particularly the case in sort of developed countries where the payments infrastructure is not great. It's particularly the case with multinational businesses that operate in multiple jurisdictions. They don't necessarily have companies and bank accounts set up in all the jurisdictions that they operate in. So when they do local acquiring through us in those regions, they have difficulties with traditional rails for getting their settlement in a timely manner and also in an efficient manner that doesn't cost them a fortune. So very interesting use cases happening in that space for multinationals that operate in multiple regions, where stablecoins really becomes a way for them to be able to manage their treasury more effectively, get their money faster, and also operate their sort of multinational treasury in a single currency, which is like a US-backed stablecoin at this point in time. So yeah, very interesting use cases, increasingly coming from what I call the traditional merchant base that doesn't have anything to do with digital assets. And in particular in regions like LATAM and APAC, where there's a lot of native kind of ground growth for digital asset usage, a lot of these businesses are now catching up and understanding that they need to be playing in that space as well.
Excellent. So from trend setting to traditional, we're seeing that move. And there's another word we'll probably talk about a lot. It comes up in almost every webinar we ever do on any topic, because it's how important for all of this to be interoperable. And interoperability is always going to come up. How are you going to bring all this together? We had a question from the audience, which is about how does this all fit in? How does this evolve with, we talked about CBDCs, central bank digital currencies. We talked about stable coins being issued by various entities and so forth. They aren't brand new. We've got stable coins out there right now, quite a large roster of them globally. But Muneeb, basically on that, Muneeb Shah, talk about the specific sectors of business, retail, wholesale, and how PSPs should start thinking about targeting stablecoins as a solution there, and how they fit in. How will those traditional revenue models be impacted by the emergence of stablecoins in the payment arena?
Thank you, Scott. I think, broadly, to be honest, it's not a question anymore of whether PSPs can afford to delay or not, right? PSPs have already taken a head start on it. The question is who's going to be a leader and who's going to be a follower. And you see the likes of MasterCards and the Visas and others already, going very big about stablecoins with some large acquisitions, as well as building platforms within that remit. So we recently ran a survey at EY, where we targeted close around 350 large global institutions, which includes corporates and banks. And around 66% of the corporates that we spoke to actually said that they expect to be active in stablecoins by end of 2026. Right? And 78% of the wider cross-border supplier payments is expected to be conducted through stablecoins in near future. And if you think about the broader adoption matrices, we do expect stablecoins to reach close around $2 to $4 trillion market cap by around 2030, right? So that, in a sense, is a good enough indicator in terms of where the market is heading and the approach that it's taking towards stablecoin adoption more broadly. Now, to your point, in terms of which sectors and which use cases, I think broadly from a retail merchant perspective, Domestic applicability of stablecoins is yet to be seen. I mean, what is it in it for a merchant, let's say in the UK, to be accepting stablecoins as against an alternative method of payment? And we might argue and say, yes, stablecoins can give them near instant liquidity, whereas, using a typical card rail, possibly they have to wait 2 to 4 days before the money actually comes into their account, and which is a good argument. The counter to that is, what is the investment required in terms of enabling the new acceptance infrastructures, and what is the ROI as compared to the loss of liquidity that they have for that 2 to 4 day period? I think that needs to be qualified and compounded. And when we think about stablecoins, I don't think we need to be necessarily think only in relation with the transaction capability of stablecoins. We also need to broaden its horizon slightly towards its wider applicability by virtue of programmability and other features that it brings to the table, and what it means for the merchants and how you can unlock more value at the back of that. As of today, I think most of the viable use cases from a stablecoin perspective are on cross-border, and they are more for mature corporate treasuries, wherein they can leverage stablecoins much more effectively for cross-border transactions. Small and medium enterprises in trade finance, again, a very ripe customer segment, which can benefit largely from stablecoins. Supply chain management can be redefined leveraging stablecoins, and particularly if you add that element of programmability, and if you add that element of invoice reconciliation, with a three-way matching of a goods receipt note versus an invoice, and the settlement requirements at the back of that. So bringing it all together, I think, will bring much more compounded value and cause a bit of adoption uptake for stablecoins more generally.
So there's a lot going on, and from what I'm hearing from you, you do have to make those decisions. Where does your money need to go right now from an investment standpoint? Is it good? Is what we have now good enough? Something intriguing that Neil said at the very beginning was, it's more about how this fits in. This isn't just a separate strategy. You kind of start it off to the side. Maybe it becomes prominent, but it starts off to the side. It doesn't interrupt your current workflows. Then you work it in. And in fact, Neil, thoughts on the remarks of your co-panelists, and talk a little bit about that build or buy question that is facing many PSPs, even if they've already got them. How do they go? Where do they go from here? How do they do these tie-ins? And why is it so important to know their customer needs and use cases first to drive further development on their stablecoin versus the other rails? We've had questions from the audience, or how does this impact FX? What else is going on? How do we keep this aligned without getting distracted?
Yeah, I echo everything you guys said there. I think that the key piece is understanding what your clients are asking for today, because there's a model here where FX is completely removed from the equation. In the context of, it was mentioned, crypto or wallet adoption is pretty high in emerging markets. And there's also demand to hold dollars within those markets. And so if you can now offer direct to wallet payouts in a dollar-backed stablecoin, and then provide the off-ramping for that through, say, a card, and one of the card networks who are making aggressive play in here as well, you actually look at a shift in the economics of where FX sits today, which traditionally is within the correspondent banking network. But now if you're a PSP, you're providing a dollar stable to an end user who's holding that in an emerging market. The economics of where that FX clip happens is in a different spot than it is today. And I think, full disclosure, we'll all say that stable coins into local currency fiat off-ramps, the pricing is not necessarily where it will be and where it can be, because we are still restricted and constrained by existing liquidity that sits in those order books. But again, we're seeing more demand for dollar-backed stable coins to be held within these emerging markets. And at the same time, we're also seeing a number of stablecoin initiatives globally for non-dollar stables. So Cuvalis, who the Fireblocks team is supporting out in Europe, a lot of work being done in Brazil. We saw some initiatives in Australia. I know in Colombia and some other markets there's, again, local currency stables. And so now it's a question of, in my head, where does FX migrate to? Because if you can now enable on-chain FX in more of a decentralized manner, permissioned pools, there's a lot of opportunity to actually tie execution and settlement together within a single transaction. And again, I'm not saying that this is at scale today, but what we have seen is an acceleration of adoption over the past 12 to 16 months in this space. And with the regulatory posture that we're seeing globally, not just in the US, it is enabling a lot of these tools or a lot more innovation to drive adoption. And so I look at traditional PSPs, they will be the adopters of probably what is laid by the more blockchain and crypto native companies who are going to actively participate within on-chain FX markets. And then when I look at some of the e-commerce and marketplace platforms whose maybe core business is not payments, but it is a very large chunk, we are starting to see that segment now move as well, because this B2C concept is really critical and similarly can or is ripe for a lot of disruption. So I don't think there's a single great answer right now for how does FX get impacted. I know that was a question that got dropped in there. What I do know is from my experience, the FX and cross-border payments markets are one and the same at this point. And if we can make both of those flows more efficient, there's a lot of opportunity out there. So I think it's a question of really how do some of these models ultimately get initially proven out and then adopted and then scaled. So tying in CBDCs, wholesale versus retail CBDCs, I think more in the developed markets, you'll see wholesale CBDCs. I know there's some smaller markets that are looking at more of a retail CBDC, but these are all, I think, levers that are going to start to emerge, and the models will be built around where the regulators actually drive, I'd say, a lot of the innovators to actually build.
Yeah, well, thank you for that. It's pretty clear the answer is going to be somewhere in the middle. I don't know about you. I just laughed at the beginning of descriptions of stablecoins, and people say, "Oh, and it's completely free." And I thought, but wait a minute. If they ever take their money out or put money in, I know because I sold FX for many, many years that someone is going to be losing money and or making money, and they're not going to be happy about that. So it's that accommodation to we figure out how all this works. That's happening now. Heinrich, anything to add to what Neil just shared? Maybe tell us about a few of the misconceptions you've heard from some of these PSPs on how to handle stablecoins. The flows coming and going all at once, 24/7. None of this takes place in a vacuum. We're ramping up instant payments all over the world. They've been around for a long time, but they're really starting to move in the US now, whereas the US was kind of a late bloomer, very, very far advanced in the UK and parts of Europe with SEPA Inst. Tell more about the local differences and the localizations and how that plays a role for PSPs in determining how they're going to ramp this up, because there's no one-stop shop, no one-size-fits-all here, right?
Yeah, well, I think firstly we need to recognize that there is a paradigm shift that's happening with digital assets and how the world can do its payments and finance activities. However, in that interim period before we get there, there is still a lot of challenges and inefficiencies before we can get there, right? So the end state looks really nice, right? Like everyone uses a stablecoin or a CBDC. Liquidity is available 24/7. You can do trading on chain, lending on chain, whatever. That's a really efficient world in the future. But I don't know when that point's going to be, but right now we're not there, right? And so if you're working with stablecoins, you're going to be paying suppliers that want fiat currency, right? Your customers still have fiat currencies. Most of your bills are in fiat currencies. So there's still going to be that having to operate in both worlds. And so that means you have to deal with legal, regulatory, operational kind of issues on both sides. So it's actually quite complicated. The regulatory landscapes for digital assets is complicated because it's not established everywhere. It's still developing in other places. Some places don't have it at all, so it's a complete gray area. So it is a tricky space, and so there are still a lot of what I would broadly call inefficiencies in that sense that we still have to deal with today. So with regards to that, in different regions. I do see sort of a main split in terms of how stablecoins adoption is tracking in different countries. In what I would call the emerging markets, right? So those are the markets where the traditional fiat payment rails are not great. There isn't great access to intermediary banks for doing cross-border payments. The currencies are weak, and the FX markets are volatile. So in those kind of regions, we're seeing a lot of retail customer demand-driven sort of stablecoin adoption or crypto adoption, where people are starting to use these because it's an easier way for them to make payments, accept payments, hold their currency, easy for them to have use that as a bank account effectively. So there's a real kind of retail-driven adoption in those regions. The businesses are then following that, right? So the businesses are going, okay, the customers, this is what the customers are doing or what the customers want. We now need to start adopting this, and then the regulation kind of comes after that, right? In the more advanced economies, which have good payment rails and have probably instant fiat payment rails, right? That retail demand isn't nearly at that level, right? So that retail demand isn't driving the adoption, right? And so that adoption, at least in my view, is coming more at the institutional level, right? So you've got, the big institutions that are realizing, hey, like we can use this technology for doing tokenization of assets and trading for that and making the liquidity and settlement processes for those faster and better. And so those institutions over the last sort of 5 years has been, pressuring governments to start regulating, et cetera. We've now got some mature regulation that are emerging in some of these advanced economies. And we're now seeing a sort of dramatic adoption of institutional level stablecoin adoption. So the use cases, in my view, can be very different in different regions. The regulation is different in different regions. And so I think that needs to be recognized for any PSP in terms of what you're trying to do and in which markets, because it's going to be different. The regulation is going to be different. And, of course, you need to choose whether you're going to, do all the regulation yourself, or you're going to offload that to some licensed third party in order for you to get into a market. These are all the choices you have to make.
Lots of choices, and you mentioned some very interesting things there. One of your points about emerging markets, one of the very first times I heard about stablecoins several years ago was a person I knew was trying to solve a problem in a country that had a terrible local clearing system, and people typically paid in USD, but how to pay the merchant across the city, literally just paying people electronically across the city. And they were trying to use US dollar accounts, and it was really difficult. They weren't qualifying. They were, and so this would be the perfect solution. But then people were talking about digital currencies as well, central bank issued currencies. We still don't know. One of the questions from the audience is, where are those going? Maybe we can talk a little bit more, but nobody really still knows how far those are really going to go. There are still discussions. I've seen Europe go back and forth on this, but I may not have the latest. That's kind of one of the things about all of this we haven't talked about is compliance. We talked about regulations, but we haven't talked about compliance and how you build that compliance. I know that's a big part of today. AI may be a part of that to help with that, because we know that when you throw a lot of bodies at compliance, there's so many questions. Those bodies can only answer so many questions and evaluate so much data. You throw AI into the mix, all of a sudden, if it's done well, you have much faster processing, still with people involved in making sure, but they've got the data a little bit more quickly, hopefully, than they did before. What does that look like now and in the future for PSPs and stablecoin handling, Muneeb? And can you share some existing or hypothetical examples of how AI might help make those stablecoin transactions run more smoothly? Oh, you're on mute.
It's about AI helping stablecoin transactions run smoothly. It's also about how does actually agentic AI use stablecoins, for purposes of transactions and for business purposes more generally. I remember way back in 2015-16, I was doing a project in Germany It's a very futuristic project for an energy company in a sense. And what we were trying to do was thinking about how do you build a new, electric vehicle charging infrastructure, by virtue of which if you are an electric car owner, you have an app. That app tells you the nearest charging station that could be available. The charging station could be at somebody's driveway. You go and charge your vehicle. You don't have to worry about how to pay, who to pay. All the back-end reconciliation would happen automatically. And we were thinking, and I'm talking about 2015, 16, at that point of time, smart contracts were still evolutionary, and we were thinking about using smart contracts then to be able to facilitate that workflow. If I look at that example today, I think it makes a perfect case for agentic AI in a lot of ways in terms of streamlining that process by itself. Or for that matter, when you think about the application of AI as of today, an electric car or an autonomous car, which is completely self-driving, enabled with agentic, having a wallet of its own, decides when it wants to get service, can drive to the nearest service station, get itself service, and pay for the service by virtue of a wallet that the car holds, and use agentic to do that, right? Just one example. But broadly thinking about in terms of how does AI sort of simplify this paradigm in a lot of ways, that we have complex onboarding processes today. We have complex know your customer, KYB, KYC processes today. A lot of that can be streamlined, automated, made much more efficient, etc. The second element is in terms of reconciliation. How do you use AI to, for example, do your backend reconciliations much more quicker, faster, simpler? How do you use AI to do your dispute resolution at the back of it, and sort of help mitigate some of the disputes? I would think those are some of the key use cases from an agentic perspective that can be thought of today, wherein AI can very seamlessly be leveraged, not just in the area of stablecoins generally, but more so in payments more broadly, right? And again, thinking about it loud, if you think about it's not just AI and stablecoins, right? So we have to think about now an ability of computing at edge. And if you're computing at edge, what you need is a confluence of AI, 5G, blockchain, smart contracts sort of work in tandem. Because if you do not have a good network bandwidth, whatever you build on top of it would not substantiate a business workflow. So when we talk about these new age emerging technologies, it's important to think through in terms of what is the baseline infra you need to get that going. We need to think about where do we leverage payments from, at edge perspective, and what do we need for that, and where does AI then apply itself more seamlessly. It's still, in its evolutionary stages. A lot of thinking is being done. At the present, I would say the best use of AI would be to look at some backend processes that we today have traditionally very manual, and sort of mitigating them by virtue of automating those workflows.
Yeah, that's what I'm thinking. No matter what use cases emerge, there are some very, very compelling ones right now, like I said, that just involve lots of data, and that if you can parse that data more quickly and easily before it needs to be acted upon by a human for whatever reason, whether in AML, whether in KYC or whatever, if you're just dealing or ongoing transaction monitoring. So the interesting thing about stablecoins, because they're relatively new, they're not brand new, but they're quite new in the marketplace. Great chance to apply new technology to address them as part of their rollout. Heinrich, any cautions? We've got questions from the audience. So what does this really mean to the customer? What's better for the customer? And I love that question, because I always like to say, yeah, but what customers are really going to use this, and how are they going to use it? So any cautions for any PSPs, B2B firms that are trying to make the right choices and priorities right now, and either how they upgrade or align their systems to where they do business, where their customers do business? What do they need to keep top of mind when they're building those compliance systems, structures, measures right now?
Yeah, look, when it comes to implementing digital asset-related products for PSP, the actual technology side of things is by far the easiest part of it all, right? You're probably not going to build your own wallet infrastructure down to the blockchain level, right? You're going to use someone like Fireblocks that has spent years perfecting that infrastructure and creating all the security measures that are really difficult problems to solve. So you're probably going to rely on that, right? And then actually implementing things like stablecoin payments, is extremely straightforward. There's nothing to it, really. That's the easiest part. The hard part is regulation and compliance, for sure. It is as I mentioned before, it is still an element that is developing and changing. There are still many problems to be solved, even in more mature markets. So even in Europe, for example, there's been implementations of travel rule, for example, in the digital asset space. That implementation, in my opinion, hasn't worked very well. It's kind of traditional regulation they've tried to adapt to digital assets, and it isn't really coherent with the way that digital assets fundamentally work. So there are still some real difficult challenges to solve, even in advanced markets like Europe. So very difficult space, and a space that is changing. You then, as I mentioned as well before, if you're going to some emerging markets, they may not have any regulation yet, or the regulation is very immature. You've got decisions being made by governments and central banks with no notice that can completely change your roadmap. That happens all the time. So it's a very difficult space, that regulatory and compliance perspective. So in my view, I think one of the key early decisions that needs to be made is, are you going to do the licensing and compliance yourself? Or are you going to rely on a licensed service provider for doing that for you? That is a big decision to make, because if you're going to do the licensing and compliance activities yourself, that is a big investment. The licensing is not easy. The compliance is a lot of things you need to implement that doesn't exist in the fiat payment side of things. Like blockchain sanction screening, and the solutions for travel rule compliance are different. They're new providers. You have to learn how it works. You have to develop your own models for risk screening and transaction monitoring. So it's a very complex set of work and resource-intensive sets of work that you need to implement. But then, of course, you have the control once you get there. But it's probably going to take you a couple of years to get there, right, at least. If you then alternatively decide that you would rely on a licensed service provider where you essentially outsource that to them, that's going to make it much easier to go live. That's going to make it much easier to expand geographically, because they have the license. They will do all the transaction monitoring, compliance activities, reporting to regulators, et cetera, et cetera. So that's nice. But then obviously you firstly have a merchant experience problem, because you have to onboard them with your service provider as well, which is never something you want to do. So that's a trade-off. And then, of course, you don't have direct control over the whole payments flow yourself. So it's a big trade-off, but it depends on how fast you want to go to market and how fast you want to spread, and what is your preparedness to invest in a licensing regime and a compliance regime, because it is a big investment. In my view, it's much, much, much bigger than the actual working with stablecoins or digital assets itself.
It's kind of like, to use two very well-used, maybe trite phrases, it's like the iceberg, everything below the water that you don't see. And then the other thing you said is nobody would like to have a Monday morning where you wake up and all the rules changed in your main operating area. So you talk about regulators. So you got to be ready, and you have to have somebody who's ready. I can definitely see that. Neil, your comments on the discussion thus far, what other factors do PSPs really need to think about when they, and emphasize when they align their payments processes with compliance, with these new stable coins? Move, as you said, work it into your flow, but not destroy everything else at the same time. You got client expectations that things are going to work. Anything we haven't yet mentioned? Any other key points regarding challenges that our esteemed panel hasn't already mentioned? Because we've talked about a lot of really, really good points. We've answered most of the questions from the audience about risk. Are we just replacing one kind of risk with another? Basically, what's the future look like if we do it right?
Yeah, I again echo everything everyone said so far. What I will say also is I fully agree, Heinrich. I think compliance is the long pole in the tent here. But that being said, this is something that we've seen firsthand with our clients. And we actually in partnership with about 20 firms, launched what we call Open Transaction Layer, which is effectively a protocol or standard for compliance around on-chain transactions. And so there's a question now of how do we understand from a more traditional business model perspective what those risks are and what the compliance on-chain means, and not trying to retrofit the existing compliance solutions products into blockchain transactions, but understanding where and how can we drive efficiencies within those processes by leveraging this technology. And so when you think about what an on-chain transaction looks like, the first thing you need to do is understand who's that wallet owner that you're sending this transaction to. So wallet verification and identity is critical. And so does that completely replace this concept of KYC and KYT? No. But what it does is now gives you new tooling to be able to verify that Fintech A has issued this wallet to that end user. Now it's a question of, can I now leverage reliance of KYC by Fintech A, knowing that they are licensed in that jurisdiction, to now make that payment directly to that end user wallet? And so I fully agree. Risk is not going away in any way, shape, or form. Everyone today, tomorrow, and 100 years in the future is going to have to manage some sort of risk in financial services. The question now is, if we reduce settlement times, we're effectively removing or reducing settlement risk and counterparty risk very materially, but now we're introducing technology risk. And so, Heinrich, to your point, you're not going to go out and build private key management and wallet technology internally. You're going to use best in breed, because that is your security layer for holding and controlling those assets. It's then a question of, okay, I'm interacting with a stable coin. There's a reason that USDC and USDT don't trade at $1. They trade at a discount or a haircut because there is inherent risk in the technology at the very least. You also obviously have counterparty exposure to that stablecoin issuer, even if they have fully backed reserves. And so it's really a question of understanding, where does the risk move from, which is counterparty and settlement risk, and where does it move to? And as we start to get more on-chain transactions, more utility of this technology, then we're going to increasingly start seeing technology risk as something that needs to be considered and ultimately priced in the market in terms of now how you transact through this new rail. So again, just to kind of summarize, because I think I went on a bit of a tangent there, is we have existing compliance and risk methodologies in place today for the way that financial markets operate today. This is a completely new paradigm shift. And so, again, not saying that it's there today, but these are the considerations that a lot of firms, a lot of consulting companies are going to need to figure out as the market continues to scale, because it's something that in financial services we've never really taken into account, I'd say, from a risk and pricing perspective.
Yeah, well, and don't apologize, because all of you have said, please don't just try to put the square peg in the round hole. Don't try to retrofit everything to fit. This is a new model. It's evolving. We've got a little bit of time. We do have a question that we're going to go ahead and hand to Heinrich regarding what, what's with stablecoin adoption at the institutional level. How is this eventually going to lead to changing consumer behavior? And Heinrich, I'm going to have you take that. Then we're going to go to Muneeb for the next question after you.
Sure. So yeah, I spoke about sort of, in emerging economies, what we're seeing there is that, we've got this retail kind of adoption of digital assets happening. The businesses and governments are now following that. And in advanced economies, at least in my view, from what I've seen, it's the opposite, where you've got the interest in stablecoins happening more at the institutional level, things like tokenization of assets, and doing asset trading on chain and things like that, and doing the settlements on chain. So in my view, I think that at some point in time, you will then see the flow happening in reverse, where those institutionals will start pushing down stablecoin adoption actually to the retail level. That's my theory anyway, because it's going to be in their interest to do so from an efficiency perspective. If you've got a large corporation that's increasingly having their treasury being run on stablecoins, they're starting to see the benefits of 24/7 liquidity, being able to send transactions anywhere in the world in a few minutes, having transparency for those transactions in terms of what their progress is, and being able to, get the benefits of smart contracts, programmable smart contracts in terms of how settlements work and how bills are paid and all those kind of things. They're going to start really seeing those efficiencies, and then they're going to go, okay, well, it's also going to be more efficient if our customers can just pay us in this stuff as well, so we don't have to FX it and worry about the fiat world. So I actually think that in the advanced economies, it'll be the institutions that pushes it down to the retail level, and that might come in the form of incentives to some degree, where maybe there's a discount for paying in stablecoins because it's going to be more efficient for that business to receive those funds that way. So I don't know exactly how that will happen. I don't know when it will happen, but that's sort of how I see that adoption almost getting pushed out at the retail level, to serve the best interests of those institutions that, well, in my view, those in the advanced economies at least, markets tend to move towards the more efficient solution over time. And so I see that as an inevitable thing on the course we're headed.
Yeah, anything that brings more ease of use and sensibility, not to mention perhaps lower costs, but all of those things, they are going to prove themselves out in the marketplace. And I don't think anybody's saying it's all going to change overnight. And I know you probably all, it would be great if you were the only person doing this and everything changed today, but that's not going to happen. And it's going to take some time. But I think as these new structures come out, if I was a customer, if I was a business customer, I'd be looking at this. And if my bank said, hey, we've got some better ways to do things to help you pay your suppliers and get paid and so forth, we're going to be rolling them out. Are you interested? If they gave me some kind of incentive to check it out, I think I probably would, especially if I'm multinational in scope. Muneeb, we've talked about how compliance can be helped. Feel free to talk more about that, but also the client experience with stablecoins, how that can become a better, be improved by implementing this by PSPs and merchants and retail or B2B, and then any compelling future use cases. You shared a couple already, and thank you for that. Anything you can see are great best practices you would talk about right now?
I think I'll touch first a little bit on the risk and compliance side, and Neil articulated it very well. But there are risks beyond technology risks that we need to be thinking of. When you're thinking about inclusion of digital assets more broadly, and stablecoins being a subset of that, and that includes operational risk, that includes your market risk, that includes your non-financial risk. So there are quite a few parameters that you need to be thinking of. You need a new set of controls to be put in place. Your risk registers need to be updated. So it's quite a quantum of work, because typically if you think about our treasuries inherently are designed to operate in a certain way, right? So they have tolerance to certain exposures from a volatility standpoint, from a FX standpoint, and whatnot. All of those metrics suddenly change, right? So you're now talking about near-term, on-time liquidity, on-time funding, just-in-time funding, and whatnot. So your treasury model changes considerably at the back of that, and reconciling that does need a bit of work in terms of coming up to the curve. And similarly, also touching a little on the point that was discussed earlier with respect to FX, as one of the use cases. Again, we did a survey with some global investment banks around 3 years back, wherein we basically asked them, what do you see today as the biggest risk to your FX business? And I'm delinking FX and payments because they need to be treated separately. We can't club them together. 3 years back, the view was that we think stablecoins are going to disrupt this, and we might be disintermediated because stablecoins can provide a much clearer PVP, DVP, quicker cross-border flows. And we were talking about automated money markets at that point of time, which didn't really fructify as yet, but that still looks like a possibility of bringing automated money market on chain if that happens. 3 years down the line, we saw some bit of adoption, some bit of talk, but never really looked at stablecoins being actively used in the institutional space for FX. 3 years later, we ran that survey again, same group of banks, global institutions, asked them the same question: where do you think stablecoins lie today with respect to FX very specifically at institutional level? And the answer was clearly that 3 years back, we thought that we'll get disintermediated. Now, we don't think it's very imminent, right? Because the ecosystem has not grown enough. Yes, stablecoins have been used in exotic currency corridors. They have been used for retail remittances, so on and so forth. We have not really seen that move up the ladder in terms of FX adoption more broadly. Now, do stablecoins have an ability to do that? Absolutely, yes. Are they treated as a high-quality liquid asset as of now to fulfill that? The answer is no, right? And that, again, goes back to the point that Heinrich and Neil were mentioning. You need a much more firmer regulatory framework. And more importantly, that regulatory framework needs to be standardized and recognized across the globe. So you cannot have a fragmented regulatory policy across the globe and each treating that asset in a different way. That doesn't really help. So I think that's one of the considerations I wanted to bring forward. And I saw in one of the comments, I think somebody had mentioned that CLS today does quite a bit of FX flow. So why stable coins? I mean, the reality is the likes of CLS would be thinking right now, so what should we be doing to prevent ourselves from getting disintermediated in the near future, with projects like Agora and others coming to fore, which are sort of disrupting the way we do cross-border payments in FX as of today. CLS also would need to think in terms of how do they service exotic currency corridors. They can't do that using their traditional models because the cutoff times do not allow that to happen. Can stablecoins, lend some value, or new digital infrastructures lend some value? I think that's to be seen. But more importantly, if you think about from a use cases standpoint, CLS today, we can argue, provides payment versus payment or a PVP scenario seamlessly. Do they provide a delivery versus payment scenario? More importantly, when you now have lots of traditional assets getting tokenized and being brought on-chain, or you have new digital assets created on-chain, which needs a very strong delivery versus payment functionality. Now, to do a delivery versus payment functionality, you need an asset leg, but you also need an on-chain cash leg. Initially, we thought CBDCs would be an alternative to that on-chain cash leg. I was talking to a very large exchange a few years back, discussing the same paradigm, and they said the way we will do DVP would only be when we have wholesale CBDCs available. We have not seen wholesale CBDCs become mainstream now, and it's very implausible that they'll become mainstream in near future any which ways. So could stablecoins be an answer for that, wherein you could treat that, in a regulated fashion to settle some large, high-value institutional, sort of trades across the board? That could be one use case that I'll actively start thinking about. And beyond that, I think one of the biggest areas where stablecoins can lend themselves is the area of trade finance and supply chain management. And thinking about its applicability broader in that area, coupled with what I mentioned before, an element of three-party goods received, a bill of lading, invoice reconciliation, matched with a quicker real-time settlement at the back of that, I think would be imperative. Domestic use cases, I'm still struggling to see in terms of what domestic use cases you might think of, even though there are some possibilities where if you're doing real estate tokenization, you could possibly think of using stablecoins from that standpoint. In countries where there is high inflation, stablecoins are anyway getting used today, as Heinrich was mentioning. I think that use case still remains. But beyond that, it still needs to be qualified at a domestic level, in my view.
Yeah, the one thing you didn't mention was sovereignty. I mean, there have been some questions on other webinars we've had about how countries can maintain their sovereignty. U.S. is by far the most dominant stablecoin. I mean, 90 whatever percent right 100%.
Now. Just on that point, I was having a conversation with the Ministry of Economic Affairs of a country I wouldn't want to name right now, and we were having this very specific conversation, and their worry was that if they let their residents now have USD wallets and have stable coins in USDs in those wallets, what effect does it have from a macroeconomic standpoint on the GDP of the country, right? And you now have a massive inflow of USD, but there is no outflow. So the answer to that is, would you need a GBP out and a USD in? Would you need a AED out and a USD and so on and so forth? And I think there was another question in the chat, are there other stablecoins getting created? I think yes, we will hopefully soon have a GBP denominated stablecoin. There is already a dirham backed stablecoin in the UAE. We have a HKD backed stablecoin in Hong Kong. So now it's a question of how interoperable they become and how they start operating at par with each other.
Yeah, that interoperability is going to be critical. We talked at the very beginning about the consortia that are evolving right now between some banks, and some banks are issuing their own stable coins, as a group and so forth. Let's go ahead and wrap it up here. We've gone through a lot of the really good points, but we're going to wrap it up with a really good question, which is what would you prioritize right now? If you're a PSP or merchant, regarding the structure, the flexibility, achieving that scale for your stablecoin settlements, or any one key ingredient, planning, execution, coordination that you think you really got to do right now, even if you're already on board, to go into the next phase of stablecoin rollout across the world and make it work for you and your customers. We'll start, Muneeb, back to you. 1 minute from you, and then we'll go to the other two.
I think I'll just start with the business case, to be honest, right? So in terms of what is the business case for me as an organization, and why would somebody be using that stablecoin if I offer it? So from a business case perspective, two critical things to be thinking of. One, what is my revenue at risk if I do not do it? And second, what is the operational efficiency that I could gain either by virtue of cost or time, and the net new revenue that I could gain if I do this? Right? I think that is what you need to compound your strategy in, and that's what your starting point is. And it's not a one-size-fits-all. A stablecoin might mean one thing for me as an organization, a completely different thing for you as an organization, because we operate in different areas. We do not have the same line of business. Think about it: a high street bank in the UK, which has very less correspondent banking flows, versus a large bank in the UK who has a global presence and massive transaction banking business. The applicability of stablecoins or digital currencies, for that matter, for these two, tangentially different, right? Yes. It might not make sense for that high street bank in the UK, which has only domestic flows, but for the global bank, the same asset class makes much more sense, because the customer profile is different, the segments are different, the line of business is different. I think that needs to be thought through and looked at more profoundly before we get onto this journey, or let's do stablecoins and for what purpose. I would say business case would be your starting point, narrowing it down both with respect to the internal workflows as well as why your customers would use it.
So know yourself, know your customers. Heinrich, 1 minute from you.
To be honest, I would echo, speak to your customers first. Again, 2 years ago, if you spoke to merchants about this stuff, they probably would have asked you to explain to them what a stablecoin is. That conversation doesn't happen anymore. Everyone knows about it now. And if in their local area and in their customer base, they are getting demand around stablecoins, they will have a conversation with you about what their needs are, what they're seeing, what the trends are. So have the conversations with your merchants, understand the regions that you're trying to operate in, what the retail base's activities are around stablecoins, what the uptake is. Really try and understand that. Then you can move on to, okay, well, are we going to do our own licensing, or are we going to leverage a service for doing that? Again, it's going to be different in different regions, but you then need to move to that conversation, and then you can go from there.
And Henrik, sorry, Scott, just wanted to add one point on Henrik's comment. It made me sort of chuckle a bit. You'd be surprised to know, as consultants, how many conversations we still have explaining what is blockchain and what's a stablecoin. Right? So if I go down that route, it's going to be a mess. So there's still a lot of education and evolution to happen on that front, while we get to that nirvana stage.
There will be some. Neil, take us home. One ingredient, one step right now.
Yeah, I'll say there needs to be top-down alignment as a technology strategy. I'd say blockchain went through its hype cycle a few years ago. We're now starting to see the utility. AI is going through its hype cycle right now. We don't know what this looks like, but I look at us in financial services at an inflection point, and this is the technological revolution. We saw it at the Industrial Revolution. We're seeing it with technology now. Having that top-down alignment with where the business is going, with this technology underpinning it, if you don't believe that this technology is going to revamp it, then there's no point in starting to execute on some tactical initiatives. But I think if you have that top-down alignment, you can then start to sort of circle around what can we do today, because everything that you do today will be foundational for the next 5, 10, 20 plus years, I would say, according to anyone on this panel, and hopefully the attendees as well.
So align and execute, and know what you're doing, know what your customers are doing, and I think all great points. I want to thank our great panel, Neil Chopra, Heinrich Venzke, and Muneeb Shah. Thank you to our audience for joining us today. This will be available on replay. Feel free to download those resources from our sponsor, Fireblocks. Thank you. Hope everybody has a great rest of your week, and welcome you to our next Finextra webinar soon. Thanks a lot. Have a great day.
Thanks, everyone.